what might happen to our market. Are we going to head down in the same way that we did in 2016 to 2019? April of 2013, we actually hit our peak market, the tightest number of properties for sale. We had 7,885. And how does that compare with now? Now we've got 4,986, so about 5,000 compared with 8,000 back then. How was the unemployment rate looking over these years? We're at a 3.6% now, which is very tight. Don't worry about what the media and other things are saying. Cut through the BS, invest for the long term, and don't make short-term decisions based on the news headlines.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to another episode of Perth Property Insider. By the time this is released, we will know the outcome of the election, and we will also know the outcome of the interest rate decision. I'm recording this on a Thursday. Election is Saturday and interest rate RBA meets on the Tuesday. So I think either way, to have both of those things out of the way and expecting an interest rate reduction of some kind, either 0.25 or 0.5, is going to be very positive for the property market, both of those being behind us. There's been a definite lull over the last month as behaviours have started to shift in anticipation of the first home buyer incentives that are going to come out. Don't yet know the timing and dates for those. And I think people are also anticipating the interest rate reduction. And whenever there's an election previously, I've found just a lull until it's out of the way. And I don't know how that affects behaviours in the market, but I'm definitely seeing it. So it's going to be a very exciting next couple of months on the other side of that. What I was going to do in today's episode is I've had a lot of people asking me, Jared, what might happen to our market? Are we going to head down in the same way that we did in 2016 to 2019 period? And what I wanted to do is take a bit of a look back in time and compare our market now with the various key stats and fundamentals to how did things look in 2013 when we were at our other peak of the market? How did they then look in 2016 when we actually hit our median house price high? But the stats had been trending down over that 3-year period before then. So that in itself was very interesting, that there was 3 years from the time that the stats started to turn to when we hit our median house price high. And then there was a further 3 years from 2016 to 2019 where we continued to slide. Things were at their worst in 2019. And then we were due for our cycle to change anyway, probably for the 1 to 2 years before that. A number of things prolonged it longer than we all expected. And COVID, which came about in March, April 2020, was a bit of a catalyst for us to start heading back the other way, funnily enough, where interest rates were decreased to a point that was stimulating the market. We had very tight sale and rental market conditions, and that started to tip things back the other way from that point onwards over the last 5 years. So let's take a look back, shall we? In April of 2013, we actually hit our peak market for the tightest number of properties for sale. We had 7,885. And how does that compare with now? Now we've got 4,986, so about 5,000 compared with 8,000 back then. So we're in a much tighter market than even our 2013 tightest market. And they had about 1,000 properties selling per week. We've got about 950 to 1,000 selling at the moment, so quite comparable in the number being sold per week, but our market's a lot tighter in the overall stock. Inventory, as a result, 1.86 months worth versus 1.32. And median house price back then was 505,000 versus our 775 now. So we've pretty much increased on the median by about 50% across the board since that tightest point in the market. Now, as I mentioned to you, our median kept increasing for the next 3 years after that. We hit 529,000. So we went up about 8 or 9% in those across those next 3 years. And at that point, our number for sale was 15,178. So it had almost doubled over that next 3 years from 2013 to 2016. And that saw the median house price start swinging back the other way. So the leading indicators of number on the market, number getting sold, were all decreasing across that 3 years. So the writing was definitely appearing on the wall for those of us that were looking at it. And if you were tuning into my market updates back then, you would have heard me telling you. So what was also happening in the rental market over that time is in 2013, we hit a low of 3,800 properties for rent. We went up to 9,875. So basically 9,900 properties for rent in 2016. And that was the peak of the rental supply. The rental supply started trending back and tightening from 16 to 2019. And that led the sale market then tightening from April 2019 onwards. So interesting that the rental market preceded that. It tightened up, it improved rental yields to that point, and then the sale market followed. So when we compare back over this time, our current number of properties for rent is 2,263. So nearly half of what was for rent at that peak tightness of 2013. We had nearly 5 times the number for rent when we hit our worst in 2016. And when we compare actual yields across that time, we've got a 4.5% yield on the median house price at the moment. At our tightest, we had a 4.8% rental yield in 2013. So fairly comparable to that. When house prices and rental prices dropped, our worst sort of yield that we got down to was 3.8% in 2019. So the yield wasn't terribly flash when we hit the turning point. It was only later, after the stats tightened up on the number for rent, that the rental price started then increasing, improving the yield, and it started to flow onwards in 2020, 2021. So the yields took a massive jump up very quickly and have continued to increase to our 680 per week now. Now let's dig a little deeper into some of that's sort of the trend in properties for sale, properties getting sold per week, and the rental market, and what sort of happened to median house prices over that time. What I want to do now is look under the hood at the fundamentals of our economy and some of those past warning signs that we can then be aware of when we come to you each quarter, and we can start to see the turning points as to, when we might be heading back the other way and when we might not be, continuing to get growth. So let's go back to 2013. The overseas migration in that peak year of tightness in all of the trending stats, we had 46,000 people come to the state in net migration to WA. Pretty good. When we were at our worst of the stats, we had just 12,483 in 2016. And then in April 2019, when things were at their absolute worst, the population increase had actually started to come back up and was starting to improve before it started to show up in the sale market again. So that was a leading indicator. So we had 16,000 migration at that point in 2019. We're now at 50,760 people coming to the state from overseas over the last year. So that's in excess of what we were seeing in 2013. And it's a long way to fall back to get to the 12,000 that was signaled the change in the market and the starting to decrease the median house price in 2016 when we had just 12,000. So a long way to go between 50 and 12. But that's going to be one of the key drivers, population growth and migration in particular, that's going to affect our rental market firstly. So people, when they come here, start out by renting. They then flow through to the house market. Everyone needs a place to live. That's put a lot of pressure on our rental prices increasing and house prices increasing over the last 2 to 3 years. So let's keep an eye on that population growth stat. And they were most current to September last year. So it'll be interesting to see when the next stats come out this year, and the population stats lagging in the time that they're reported, but they're a leading indicator still in terms of what's going to happen to the median house price in Perth.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
Now, when we take a little look deeper, the interstate migration was 7,000 people in 2013. We've had close to 9,000 people in 2025. At its worst, get ready for it, we had nearly 8,000 people leaving our state to go to the other states, and that was in 2016. So again, a long way to go from our 9,000 positive to minus 8,000 leaving. So we'll keep an eye on that stat as well. Let's take a look at some of the other things. Interest rates. So they were at 3% in 2013. They got as low as, looks like 1.5% cash rate at April 2019, the turning point for Perth. And we're at 4.1% now. So hasn't always been material in what's happening to the above stats. We've been up, we've been down. We're about to start decreasing, and that has had an impact, you can see, because 2019, the rates got down low. It then increased the monetary supply and it turned the market again. So we're going to have almost a mini second cycle going on here where we've had our rates high for a while. That's certainly put the brakes on other capitals like Sydney and Melbourne, especially where lending is higher historically and affordability lower. And in Perth, we've sort of bucked the trend of that along with Brisbane and Adelaide. But with this going into this second growth phase, as I'm calling it, with interest rates decreasing, that's going to improve affordability, improve rental yields, improve that what it costs to hold a property as an investor, and people are going to be willing to pay more as a result in their purchase prices. So that's how it's going to flow through. Ironically, the government, in trying to solve their housing problems and trying to help first home buyers into the market, what they're actually doing is just increasing the demand. They haven't really added significantly to the supply. They've got wafty plans and, we're going to build 1.2 million houses. We've had improvements to our number of properties getting built here in Perth, but across Australia, there hasn't been any significant improvement at all. And what we're doing is increasing demand without increasing supply. So it's only going to lead to one thing. And it's so crazy to me that the politicians are doing that. But on the other hand, they have come out in the recent election and talked about reducing overseas migration by 20%. Looks like both of them are going to do that. So we will see how that shows up with the proportion of people coming to Perth. If our population migration decreased by 20%, that would take us to about 40,000 per year if there wasn't any other change. So I think that would still be historically very high and still supportive of pressure on prices. But again, that they don't control exactly where the people go once they get into the state, and we've been seeing the highest percentage terms. So that would likely still be the case if our economy is strong. Which brings me to my next point. How was the unemployment rate looking over these years? We're at a 3.6% now, which is very tight. We haven't really started showing any signs of increase back to where we were in danger time. So 2019, when we hit our worst point and started trending back the other way, we were at 6.1% unemployment rate. So nearly half, not quite half, but about 40% less than where we were at that time. So that's significant. We need to watch the unemployment rate for me and the overseas migration and interstate migration. That's the top three numbers to look at a fundamentals level as to what is going to flow through to houses. So we've got a long way for our unemployment rate to increase before it gets to those worst of times. That's for certain. 2016, when things started to show actual decrease from that point onwards, we were at a 5.5% unemployment rate. So a long way to go from 3.6 to 5.5 in the world of economics. That's a huge number of people that would still have to be without a job. Now, what we need to look for in this is the danger on the horizon, as we know, and you've heard me speak about in recent episodes, is the slowdown to the world economy caused by Trump's tariffs. So what that's going to potentially do is China's going to likely be most affected by these tariffs. They're getting the highest tariffs imposed on them. It'll be interesting to see how they change around their trade and to what extent that may slow their economy and all of the Southeast Asian economies that are our main trading partners other than the US. So, with our iron ore being one of the largest exports, well, the largest export for WA, keeping an eye on that price as well. We were at 36 US dollars a ton in 2016, and it did continue to increase back from there to 2019. We're at $74 a ton. We're currently at $99 a ton. You'd think that the iron ore price again is reflective of supply and demand. So if the demand starts to decrease significantly from China, we may see that price decrease and also the volumes decrease that are being exported. So we'll definitely be keeping an eye on that iron ore price and hoping that some of these trade wars go in our favour. I know for Australian beef, China's now suddenly become one of our top importers. We're exporting some of the most to them because they used to get their beef from the US, and now with the huge tariffs placed on it, it's cheaper for them to buy from Australia. And all of a sudden, that whole industry has had a big boom, and China's gone from way down the list to second in terms of where we're exporting beef to. So hopefully we get some wins like that, where what China was buying from the US, they might start buying from Australia. Hopefully the wine industry, our agricultural industries, these types of things, we'll still see that. And hopefully China can still maintain their level of expansion and building and prosperity to a reasonable extent so that the need for our minerals and resources are there. I think the other factor that's worth mentioning at a global level is, as in terms of need for resources, there's a big trend going on to improve and reduce emissions. So that's causing massive infrastructure spends to change over to renewables, which WA and Australia as a whole are very well positioned with our resources to provide for that. And the other trend that is going on still with the war in the Ukraine and conflicts over in Gaza is that a lot of the nations of the world are increasing their military spend as a percent of overall GDP. And what's needed for military spend is a lot of our resources too. So those trends are definitely going against the Trump isolationist slowdown trend, if we call it. And look, who knows how long Trump and his trade wars might last. This could be old news in a month or two, could be completely blown out of proportion, and we may just be looking at that in the rear mirror soon. But as I've said in last episodes, don't worry about what the media and other things are saying. Cut through the BS, invest for the long term, and don't be making short-term decisions based on the news headlines. So hopefully that's been informative. It's certainly given me some perspective as to just how strong our economy and property market is still. And we've potentially got another 3 years of median house price increases is just high level. Obviously, it depends on the rate at which these things change, which I can certainly be filling you in on each quarter when I come to you. And keep in mind, this is just me talking about our overall economy, our overall median house price. At any one time, each suburb in Perth is going through its own cycle, and different suburbs represent better value for buying. And when we have our data-driven approach, we can select the suburbs that are most likely to outperform in the short and medium term, as well as the long term. And that's why I think our buyer's agency has become so popular in that in previous markets, you could throw darts at a board, select any property, and you would have seen a 50 to 70% increase. Now we need to be a lot more selective. You need to really know what you're doing with your research to select properties, and we can really pay for ourselves even more so than usual because we can make the difference in the extra gains that you can potentially make. Hope this has been a good one. Hopefully you've learned a few things. If you have, share it with family and friends. Like us, do post a review if you haven't done so already. I really appreciate that. It gets the show out to more people. And I'm looking forward to catching you on the next one.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.